Welcome to an in-depth analysis of the electric vehicle landscape as we project toward 2026. For investors, venture capitalists, and angel partners, the paradigm is shifting from speculative growth to measurable value. We are moving past the era of growth at all costs into a period where the enterprise value to EBITDA ratio becomes the gold standard for valuation. By 2026, the market will distinguish between companies with sustainable margins and those burning through capital. This presentation will dissect why EV to EBITDA multiples are compressing, how top-tier OEMs are positioning themselves, and what specific data points you need to watch to maximize your portfolio's performance in the next 24 to 36 months. Why use EV EBITDA? Unlike the PE ratio, this multiple accounts for debt and cash levels, providing a clearer picture of a company's operational efficiency. In the high-intensity capital world of EV manufacturing, debt is a constant. As we look at 2026, we expect the median multiple for pure-play EV manufacturers to normalize. Historically, we saw multiples of 40x or even 100x during the 2021-2022 bubble. However, our forecast for 2026 suggests a more grounded range of 12x to 18x for market leaders. This normalization reflects a mature industry, where production scale is no longer a question, but operational profit is the primary driver of enterprise value.
What drives the EBITDA side of our 2026 equation? It is no longer just about the number of units delivered. We are looking at three critical pillars: software as a service revenue from autonomous features, decreasing battery costs per kilowatt hour, and manufacturing automation. By 2026, we expect software margins to contribute up to 20%. The valuation gap between pure-play EV companies and legacy OEMs is closing, but a premium remains. Legacy automakers are trading at 5x to 8x EBITDA, burdened by their internal combustion engine heritage. Conversely, high-growth EV players are being valued at a premium for their lack of legacy debt and more agile software architectures. By 2026, we project that the most successful legacy converts will trade at 10x, while the top pure plays will maintain a 15x premium. This 5-point spread represents the innovation premium that VCs and angel partners should target when looking for high-alpha opportunities in the 2026 timeframe. No forecast is complete without a sensitivity analysis. The 2026 EV to EBITDA multiples are highly sensitive to interest rate environments and global supply chain stability. If interest rates remain higher for longer, the cost of capital will drag down EV to EBITDA multiples by approximately 2 to 3 points across the board. Furthermore, lithium and nickel pricing volatility can swing EBITDA margins by 500 basis points. Investors must look for companies with vertical integration, those who own their supply chain or have long-term fixed-price contracts. These firms will trade at a lower risk discount, maintaining their multiples even in a volatile 2026 macroeconomic climate. Who are the winners in 2026? We are tracking three distinct tiers. Tier 1 consists of efficiency leaders with EBITDA multiples of 18x, driven by massive scale and energy ecosystem integration. Tier 2 contains market disruptors, trading at 14x, characterized by niche dominance in luxury or commercial segments. Tier 3 includes legacy transitions at 9x, struggling with pension liabilities and retooling costs. Our analysis suggests that the enterprise value of Tier 1 players will grow by 40%. To finalize our 2026 outlook, let's look at the formulaic approach to enterprise value. EV is calculated as market cap plus debt minus cash. In 2026, we expect cash on hand to be a major differentiator. Companies with high cash reserves will effectively lower their EV, making their EBITDA multiple look more attractive to value-oriented investors. As we move into 2026, look for companies with at least 24 months of runway and a debt-to-EBITDA ratio under 3.0. This financial health, combined with a 15x multiple, creates a strong buy signal for partners looking for a safe harbor in a high-growth sector. In summary, the 2026 EV landscape is one of maturity and disciplined valuation. The shift to EV to EBITDA multiples as the primary metric reflects an industry that has finally come of age. We anticipate a median multiple of 15x for high-performing pure plays, driven by software margins and manufacturing scale.
Investors should prioritize firms with vertical integration and robust cash runways. The opportunity for outsized returns remains, but it requires a pivot from chasing hype to analyzing hard operational data. Thank you for joining this session. We look forward to discussing how these 2026 forecasts can inform your strategic investment decisions today.